on average, we can survey a broader scope of lender and provide a cross section of whatever product is of interest to you. And so, especially at renewal, I think that's one where we've seen gaps of up to half a percentage point difference between a bank offering and what we can get them through either a non-bank channel or through a different bank.
Welcome to the Steadyhand Coffee Break series, where we dive into matters of finance that matter to many Canadians. Whether you're planning for or living in retirement, or frankly, retirement is not even on your radar, I hope you'll find our topics and discussions helpful. And if you're new to our channel, be sure to look around, and if you like what you see, please subscribe and click the notifications button so you can be alerted as soon as we upload new videos. Now, today we are discussing the proverbial American dream, well, one that Canadians share too. Of course, we're talking about home ownership. But behind the dream of ownership lies an important and sometimes bewildering step, and that is securing a mortgage. It's a process that can be as daunting as it is necessary, filled with terms and procedures that seem complex at first glance to most of us. So today we're laying bare the myths, truths, facts, and figures of mortgages in Canada. And to help us understand all this, we're talking with Ray Macklem, a seasoned mortgage professional with Nest Mortgages located in Vancouver. Ray and I are going to dive into the mysterious world of mortgages, approvals, renewals, prepayments, teaser rates, defaults, and insurance, and I'm sure much more. Ray, it's great to have you on the Steadyhand Coffee Break. Welcome.
Thank you for having me.
Pleasure. Why don't you start us off by sharing a little bit of your background, how you got into the industry, and frankly, your experience in the industry?
Yeah, I mean, nepotism is the short answer. I was studying economics in university, and my father has been a mortgage broker since probably before they were called mortgage brokers. And he introduced me to a friend and colleague of his who hired me on the sales side of things. So I worked for a technology firm originally, out of university, doing sales and service for both mortgage brokers and lenders. So it was nice to get to see both sides of the ledger, working with lenders to see how their systems operate and their processes, and as well as brokers just to get the other side of it. And it was a couple years after that into that where a client of mine had actually wanted to get out of the industry. And I'd moved from Vancouver to Calgary to take over their mortgage book in 2007. And I've been doing it ever since. So for the last 16 odd years, I've been brokering mortgages.
And what were interest rates like back when you started in this business?
Yeah, you know what? A little bit higher than they are today. The first mortgages I put out were for about 5.9% back in 2007. Yeah. Right before the subprime crash.
Right. Well, I guess we've sort of forgotten about those days.
Yeah.
So let's get into it. What is a mortgage, and how is it different from a traditional line of credit or something called a HELOC, which you can explain as well?
Yeah. So a mortgage is effectively a loan that's used to buy property, whether it's raw land or real estate. The mortgage itself generally is considered like an amortizing loan, meaning you have both principal and interest repayment. Whereas a line of credit tends to be an interest-only payment and a little bit more flexible, where you can apply some balance to the principal or not. The difference between a line of credit and a home equity line of credit is generally lines of credit are unsecured, whereas home equity lines of credit use the title of your property as security for the loan. So they are securitized against the actual property itself.
Why would you want one over the other?
Home equity lines of credit generally are considered tools for some purpose or an adjunct to the mortgage. You can add them on for one reason or another. So, for example, if you are self-employed and maybe you struggle with cash flow through certain times of the year, having access to a home equity line of credit is a benefit where you can use that to weather the storm during maybe leaner times. A lot of people use it for investment, or if you want to get more complicated into things like Smith maneuvers, those can be useful tools for that. Generally speaking, home equity lines of credit come at higher interest rates. So we tend not to want to see large balances carried on those. Usually mortgages are a cheaper instrument, and people want to, historically Canadians are pretty risk averse. They want to get rid of those as quickly as possible. Going with the cheaper interest product is usually the choice. So they can be a very useful tool, and they are a very useful tool, but home equity lines of credit as a replacement for a mortgage, they're not really designed for the same thing necessarily.
If I had a home and I had a mortgage on it, but I wanted to renovate the kitchen or put a new roof on, and I needed to borrow some money to do that, am I typically going to re-up my mortgage, or am I going to go with the HELOC?
So a lot of times what happens is people will use a home equity line of credit to start that process, especially if you're doing a major renovation that happens over a longer period of time. Because when you refinance to take out all that money for, say, a major project, you're paying interest from day one, dollar one. So if you took out, for example, $150,000 for a major renovation, you're going to be paying interest on the mortgage right from day one. Whereas with a home equity line of credit, that project may go on for 6, 12, 18 months. You don't necessarily want to pay interest the whole time. So having staged draws through a home equity line of credit could lower your overall borrowing costs. And then at the end of it, one of the nice things about those home equity lines of credit is you can actually convert them into an amortizing loan once the project is completed. So depending on the scope of the project or how long it takes, that might be a more cost-effective way to approach it, which can then be converted into a cheaper instrument down the road.
Okay, and that's why you've heard of HELOCs being referred to in the media as almost like ATMs. You can just simply draw down as you need to.
Yeah, absolutely. Yeah. Oftentimes, what is the saying? I think I'm actually stealing this from one of your colleagues, where banks they hand out umbrellas when it's sunny and take them away when it's raining. So a lot of times when we're setting people up at renewal or refinancing, we're looking forward to build in capacity, because if you can set up that home equity line of credit with a cost that maybe you incur once, it's a forward-looking instrument that can be utilized, but you don't necessarily pay on it if you're not using it. So if so if you've got that capacity built in, and that's for responsible borrowers, you don't want people obviously just accessing their home equity willy-nilly. But if you can set that up to start off with, it can lower your overall cost down the road. You've got that tool available, and it's just a simple one-time setup type thing.
First-time home buyer, newbie, where would they typically go to get a mortgage in Canada? And I assume there's different providers of mortgages. What can you talk a little bit about the pros and cons?
Yeah, I think most people initially revert to online research. I think we're in the age where everybody wants to Google it and figure out what's going on, but mortgages have gotten unnecessarily complex, I think, in a lot of ways. But the general providers are banks, credit unions, trust companies, and mortgage finance companies. Mortgage finance companies, non-bank lenders, they are a branch of institution that the public doesn't necessarily have access to unless you're dealing with a mortgage broker. A lot of them are publicly traded companies, but there are many different ways to go about accessing it, and a lot of choice right now. So, and obviously a lot of competition. So borrowers can start by approaching their bank. They can start by approaching a mortgage broker. They can start their research online. My biased opinion is consulting a mortgage broker is a good first place to start to get a broad overview of the market and products.
Well, let's go a little bit deeper on that. You can either default to the bank where you've been banking for 25 or 30 years or what have you, or you could do a little bit more research and find a mortgage broker. What's the benefit of using a mortgage broker? You can talk your book now here, Ray.
Yeah, so obviously a little bit of bias on this side of things given what I do, but I do believe that having an unbiased third party to review your options for you and explore the nuances between the different channels of mortgages is a great starting point, right? And when you're sitting across the table from somebody that has a vested interest in that particular mortgage product, and they only have one suite of products to offer you, how can you be sure that you're getting the best product and best advice for your particular situation? They can only sell you, if your bank, for example, can only sell you your bank's products, whereas a different lender might have a more suitable rate, product, set of features for your particular situation.
So if I go to my bank and ask for a mortgage, I'm going to get a mortgage from my bank. But if I go to a mortgage broker, I could get a mortgage that is underwritten by a bank, or it could be underwritten by one of these other, you called them, I think, near banks or?
Yeah, non-bank, mortgage finance companies, non-bank lenders.
That sounds risky for some reason. Should I be concerned? Or I guess I'm borrowing the money. Why would I be concerned?
Yeah, I get that question a lot, and sort of have a running joke. If you borrow some money from somebody and they disappear, isn't that a good thing? However, it isn't that simple. Obviously, mortgage contracts in Canada benefit both parties, and it is incredibly difficult to become a mortgage lender. So these entities are vetted heavily and have insurances and all kinds of fail safes behind them. We have had non-bank lenders go out of business. For example, Macquarie Bank from Australia came in and left the channel. And what happens in those situations is another institution will pick up that book of mortgages and service them, and then eventually renew you into their channel down the road. So there is no risk from a borrower standpoint of going with a non-bank lender. Many of these institutions are publicly traded companies, and a lot of them, their primary investors are the big banks in Canada. They just don't have the brand cachet or recognition that, say, a lot of the big banks do in our country.
And anecdotally, based on either your practice or just your knowledge of the mortgage broking practice, what percent of mortgages would be underwritten by traditional banks versus non-banks?
Banks have the lion's share of mortgages in Canada. Right? And, I mean, the mortgage broker channel itself has less than 40% market penetration in Canada. So we are definitely the David to their Goliath. And even through the mortgage broker channel, odds are you're probably at least 50% going to be dealing with a financial, like a big bank, a charter bank. They are some of our biggest clients on our channel as well.
Can you give us some sort of teaser around what I can expect to save in terms of the interest costs or any other sort of negotiating capabilities that you as a mortgage broker bring to it versus me going directly to the branch?
Yeah, I mean, it's a very competitive market, and I think a lot of the rule changes that have been affected have changed the landscape in terms of ability to price mortgages. And so, from our standpoint, when we're looking at a client situation, the first thing we're going to look at is obviously the interest rate. Anybody who says otherwise is probably a little bit off the rocker. It is the most important piece of a mortgage, in my opinion. Different lenders have different pricings at different points in time. So if you approach your bank when they are, say, full of variable interest rate mortgages and their appetite is more for fixed, you're not going to get the best pricing on that particular product. So on average, we can survey a broader scope of lender and provide a cross section of whatever product is of interest to you. And so especially at renewal, I think that's one where we've seen gaps of up to half a percentage point difference between a bank offering and what we can get them through either a non-bank channel or through a different bank.
So you can benefit the borrower. How are you compensated in this whole arrangement?
Yeah, so we're compensated by the lender. We're paid a finder's fee by lenders to provide them with qualified applicants and documentation, and it comes out of the interest of the loan. So it's not an additional cost to the borrower that's sort of tacked in or rolled in. And there are many disclosure forms across the country that have to go through all those just to make sure everything is disclosed to clients and they understand where everything's coming from.
So let's dive a little deeper into the qualification process. I'm looking to borrow money. What are the mortgage lenders looking for when they're assessing whether to lend to me or not? I know there's a credit score issue. I know I have to assert income, all that kind of stuff. But what gets rolled into that assessment?
Yeah, what I usually tell people is mortgage qualification at its root is just a ratio of your monthly expenses divided by your monthly income. So then they have to fall within certain guidelines and ratios, and obviously now with stress tests and new guidelines, those ratios are rather strict. In addition to it falling into those guidelines, there are things like credit that are important. Your beacon score has to fall into certain ranges at certain levels. They are going to look at your employment history in terms of the strength of your employment and overall income history. They are going to look at your asset base in terms of liquidity and fallback resources. Those are the primary things that banks are looking for when they're assessing the overall risk of a loan, in addition to the property itself, right? The property forms the security for the loan. So that is a piece that banks will look at, whether it's appraising it out or assessing the value of it and condition of that particular property as well.
Did you say beacon score?
Yeah, beacon score, credit score. Yeah.
Beacon, I've never heard that expression.
Your beacon score would be the number if you pull your Equifax credit score. That number, if it's 743, would be dubbed your beacon score.
Cool. And then when the bank or the lender does their sort of assessment, I think I've seen people driving cars around neighborhoods sort of with notepads and stuff like that. Is that what they're doing, or are they going deeper than that?
So there's a couple of different ways they can assess a property. There are automated valuation systems that companies like CMHC have developed based on the physical characteristics of the home and through tax assessors, where they can just plug in an address and get an assessed value of that home. That's a pass or fail type thing. And if we ideally we want to get those because it's more cost effective for the borrower and much quicker. But failing that, they will actually send out an appraiser to the property to visit it, to take the physical dimensions, take pictures, do a report, compare it to recent sales of homes that are relatively similar to the one that's being assessed.
And how often is that an element of risk to the buyer? So I bought a house for X, and the closing time is say 3 or 4 months. And then is there much risk that the assessment that the bank does on the value of the property could be a lot different than what I paid for it?
There is some, usually when we do that, it happens within a subject removal period where you have a week or two to do the due diligence, to order the appraisal, to get the valuations before you formally buy the property. So the risk tends to be pretty low. Where we've seen that become an issue is in pre-sale completions, things that were purchased in years gone by, and maybe market valuations have changed and appraisals don't come in at value, and there's got to be some creative solutions involved in that. So it's less of an issue on resale property transactions, but has the potential to be an issue on pre-sale transactions that have a much longer closing horizon.
Okay. And what would be the number one reason why somebody going through this bank evaluation process would fail to get a loan?
Yeah, first and foremost would be the debt service ratios. The ratio of your expenses divided by income. That, especially with higher interest rates, has become an increasing challenge in affordability. The second piece would be credit, would be probably number two on the list there, if your credit score doesn't meet the requirements of lenders.
What are the sort of the high level guidelines for debt servicing?
So debt service ratios, total debt service ratio would be a ratio of all of your debts divided by your gross income, need to fall in around 44% or less. Gross debt service ratio just factors in the housing expenses. So things like your principal interest payment, property taxes and heating costs or condo fees needs to be under 39%.
Is that publicly, like, can I Google that?
Yeah. CMHC has these guidelines. OSFI as well, the Office of the Superintendent of Financial Institutions, has all of these guidelines published.
Okay. We're going to get into interest rates in a moment, which are obviously hugely important. But as I go about securing my mortgage, what are the costs and fees that are involved that are probably going to be really, irritating?
The biggest ones, provincially, land transfer tax is a big one, especially in Ontario and BC. BC recently just changed their rules around that to provide a little bit more relief. But property purchase transfer tax, land transfer tax is the biggest one. Legal fees. So anytime you are transacting or refinancing, you are changing the title of the property, which involves land titles and notaries and lawyers. That would be your second biggest cost. Beyond that, you're looking at things like home inspections, just to make sure that the home you're buying is in a quality state, or if there are any issues, you're aware of it. And another cost would be the appraisals that we spoke about as well. So those can be costs that go along with the transaction.
Okay. But the biggest cost, of course, is the interest rate. So how do lenders charge for their mortgages?
Yeah, so fixed interest rates are typically based off government bond yields, and a spread is added on for risk evaluation, loss provisions, depending on the timing of the market. So fixed mortgage rates are typically based off government bond yields, whereas variable interest rates are based off prime lending rates and Bank of Canada overnight rates. So those are a little bit more flexible and changing, whereas the fixed mortgage rates a little bit more predictable, and we can see those moving in real time, right? If you're watching government bond yields, we know if we're going to see interest rates rising in the short term or the long term.
So let's peel that back a little bit. What's the difference between a fixed interest rate and a variable interest rate on a mortgage?
So a fixed interest rate fixes your rate for the set term of the mortgage. So those typically come in 1, 2, 3, 5, 7, 10-year terms. So whatever term you choose, let's just say you choose a 5-year mortgage, your interest rate is fixed and guaranteed for that 5-year term. And it cannot change regardless of market circumstances. With a variable interest rate, what you are guaranteeing is a discount generally against the prime lending rate. So let's say, for example, right now you're getting prime minus 0.9%. It's that discount against the prime lending rate that's guaranteed for the term of the mortgage. However, prime can and will change over that term. So if the Bank of Canada were to lower interest rates later on this year, your interest rate, that prime rate would drop, your discount would stay the same, and your interest rate would fall along with the prime lending rate.
And you talk about the term. There's another fancy term in mortgages called the amortization period, I think. What's the difference between those two?
So in Canada, your mortgage is amortized over a period of time. And that's typically 25 or 30 years. And that's the total length of time it's going to take you to repay that loan. But that amortization period is broken up into smaller chunks called terms. So, on average, people tend to prefer 5-year terms. So if you were to take a 25-year amortization mortgage, you're probably going to have 5 terms over the life of that mortgage where you're renewing at set intervals.
And how do you advise your clients to choose between a variable or a fixed interest rate term?
Yeah, it's certainly challenging these days. A lot of it comes down to just a risk assessment, right? Especially right now where we are probably on the precipice of rate cuts in the back half of the year. It's a function of which side of the risk equation do we want to be on. So if we were analyzing today, we would say, okay, the upside of taking a variable rate mortgage right now is the likelihood of rate decreases are coming. And there's also an added flexibility of that variable rate mortgage where you have the ability to convert it to a fixed rate during the term. So let's say we did witness some rate decreases and fixed rates dropped to a level that was a little bit more palatable. You have the option of taking that variable rate and converting it to a fixed rate as long as the term you're converting to is at least as long as what you have left. So if you have 3 years left on a variable rate mortgage when you look to convert, you've got to convert to a 3 or 4 or 5 year. So the upside being that you might be able to take advantage of some rate drops in the near future. The downside is, well, if that doesn't happen, you're stuck at a higher interest rate because variable rate mortgages are higher than fixed mortgages right now. So let's say inflation becomes a little bit more difficult, sticky to tame, and the Bank of Canada has to hold up rates for longer. That's the downside risk of taking a variable rate mortgage. Now, on the other side of the ledger, with fixed rates, the advantage is you get to fix that rate and you don't have to worry about the emotional roller coaster or the powder keg that is the Bank of Canada and their policy rate decisions. So the upside is you get certainty that you can sleep at night and know that in all likelihood, we are renewing into a period of time where rates will be lower, right? If we took a 3-year term today, odds are interest rates will be lower in 3 years' time than they are today. The downside is if interest rates drop, we're stuck at a higher interest rate. And it's going to be a little bit more expensive to get out of that mortgage because as interest rates decline, penalties tend to go up for mortgages. So let's say we start at 5% and rates drop to 4, hypothetically. I'm not suggesting that's where they go. Then the penalty to discharge that mortgage is going to eat up any potential interest rate savings of a lower interest rate mortgage. So it's an assessment of where we're comfortable. And I would say people tend to be a little bit more on the fixed rate side these days. Just based on obviously recent history. I think there's a little bit of PTSD from our past rate trajectories, but it really becomes a function of what side of the risk equation are you more comfortable with.
Well, interestingly, those rate trajectories of recent past are only, 2 years in the making. And so it's interesting to hear people sort of locking in on fixed rate now with the concern that rates might actually go up from here. It sounds like everything related to interest rates and mortgages hinges on the Bank of Canada and its rate decisions.
Fixed rates, less so. Fixed rates are based off Canadian government bonds. However, yes, the Bank of Canada does have a heavy influence over that as well, right? Because those products are traded based on future predictions of Bank of Canada's path as well. So yes, there is a heavy component of influence on their part.
How can a borrower accelerate? We talked a little bit about prepayment, that kind of stuff, or switching over from different terms or from variable to fixed, et cetera. But what are the ways that you can accelerate or decelerate payments?
Mortgages are pretty flexible generally in terms of their ability to pay and prepay. The accelerated payment version is something that's very popular in Canada because in essence, like in simple terms, if your payment were, for example, $2,000 a month, over 12 months, you would pay a monthly payment of 24,000, or sorry, an annual payment of 2,000 times 12. Whereas an accelerated payment takes that monthly payment, cuts it in half, and you pay it on a biweekly period. So that would be 26 pay periods of $1,000. So in essence, what you're getting is one extra month's payment that's divided over 26 different pay periods. So it's a relatively painless way to prepay the mortgage. And on average, it takes about 3.5 years off the life of the mortgage. So accelerated payment terms are a popular move in Canadian mortgages, and as they should be. It's obviously, especially with interest rates being a little bit higher, I think people want to get out from under that burden as quickly as they can. Over and above that, every mortgage will generally come with additional prepayment privileges where you're allowed to apply lump sums or increase your monthly payment beyond the minimum level to pay that mortgage off a little bit more quickly. So some lenders will allow you to on any scheduled payment date. Some lenders will require it to be once per year, but there are, generally speaking, a fair amount of flexibilities built into paying that mortgage off more quickly than, say, the 25-year amortization schedule will suggest.
And we would typically get questions from clients who are deciding whether to, make a contribution to their RSP with, free cash flow or savings, whether to make a contribution to the TFSA, or whether to pay down their mortgage. And 3 years ago, it was a lot easier to kind of like do the math on that. But nowadays, it's like, whoa, everything's sort of in that mid-single digit range, and then you've got you got to factor in tax equivalency and all the rest of it. Do you get involved in those kinds of that kind of advice?
In conjunction with financial planners, I mean, that's a more complicated question than just what should I do with my mortgage, right? And so people have larger financial plans, and that's where in tandem with a financial planner, we'll have those conversations, break down the math, and see what makes the most financial sense. But I tend not to give unilateral advice on that because I know there are other components to people's financial health that I'm not privy to.
Fair enough. So we hear in the media about a mortgage renewal cliff. What's that all about?
It's a nice term. It's like all these weather terms that atmospheric rivers and heat domes and things like that. Very dramatic and attractive to clicks. And it is a real phenomenon. There are a substantial amount of mortgages coming up for renewal in the next 3 years to the tune of approximately 900 billion. So it's not a small number. And what that mortgage renewal cliff is referring to is the fact that a lot of those mortgages are going to be coming out of lower interest rates and renewing into higher interest rates, which is going to provide a fair amount of payment shock and obviously have money going more towards mortgages than to discretionary spending. So it is a very real phenomenon, albeit I do think it's a little bit exaggerated in terms of some of the numbers I've seen.
Should we be worried about it? As an economy, should we be worried about it?
I think it's definitely something to be conscious of, and I think it's something that the Bank of Canada is acutely aware of. Is, in addition to raising interest rates, they have to be conscious of the fact that a lot of the lag that comes from their policy decisions is yet to take effect, and that does come in the form of these later stage renewals. So people that are renewing, right now, for example, if you wind the clock back 5 years, we were putting people into mortgages that were around 3.5%. So if you're going from 3.5% to 5%, that's not such a big deal. But I was speaking with a client this morning who we put in at 2.44%, and they're renewing next year. So where do interest rates sit in 12 months' time? How does that impact things? So, 5 years ago, people are experiencing roughly a 16% payment shock. I think there's a fair assumption that interest rates will sort of trend downwards over time. That will ease a lot of that mortgage renewal cliff pain. But there is going to be a significant change, I think, for a lot of people, where their budgets are going to be going more towards their mortgage payments and less towards discretionary spending, which is obviously going to slow things down for the Canadian economy. So I think it is a very real effect.
Which would support a view that interest rates may well be, positioning for decline simply because of that mortgage cliff impact on discretionary spending in the economy writ large.
The Bank of Canada, I believe, has acknowledged that explicitly. And as they should be. It is something that I think they're well aware of. If they maintain this policy rate for too much longer, that it will have some serious negative consequences to the economy.
Well, speaking of renewals, is there a different process if you're renewing versus getting a brand new mortgage? And when should you start to think about that?
So renewing is a different process. You can choose to renew with your existing lender and just select the term and product that you want with that particular institution. But a lot of times people are looking to make changes at that time. With financial planning, you review the assets and financial health of that particular client. And mortgage renewal provides that opportunity to look at the debt side of things and just make sure debts are optimized. If there's any additional unsecuritized debt or higher interest stuff that is less efficient, we can look at ways to make that more efficient. Or if the borrower has specific financial goals, whether it's investment, whether it's home renovations, renewal does present that opportunity where your mortgage, you're effectively a free agent where you can examine your situation, make the necessary changes without fear of penalties or consequences on that side. And typically that process, we want to start 4 to 6 months outside of your renewal date. Something as simple as providing a mortgage statement where we can compare existing options. And if we need to get into more detail, we can look at applications and financial balance sheets just to make sure that debts are performing in the best way for that particular client.
And is it possible that over the course of 4 years, my career has progressed to a place where or, for example, your spouse may have stayed home for a couple of years to help raise kids. Now they're back, so your whole economics have changed. So it's possible upon renewal that you actually are a better credit risk and you could get better terms.
Yeah, definitely, right? I mean, incomes tend to rise over time, and housing values obviously have risen over time as well. So from a lender standpoint, you are more desirable. First of all, odds are you paid your mortgage for the previous term, which makes you a desirable commodity to a new lender. The risk is inherently lower as a result of that, but also because your income has risen, your debt service ratios will likely fall, and your equity situation will have improved as well. So you are definitely more. Banks love renewals because they are proven commodities, right? And that's why we joke about you being a free agent athlete. You can take your talents to South Beach and look at wherever you want to go and find the best situation for you.
Well, Ray, you've just covered the situation where somebody's financial situation has improved and they're contemplating renewing their mortgage. What happens if your financial situation has deteriorated?
That is something that does happen from time to time, and I think there is some concern about requalification. One of the rule changes that we saw previously was adding things in like stress tests. And the question I get a lot is, what happens at renewal if I don't qualify? And as long as your mortgage is paid and up to date, regardless of your financial situation, your bank will likely offer you a renewal term. So it's not that you won't necessarily requalify or have to worry about that requalification step. If you're not making any changes to your mortgage, you can just strictly renew with your lender into a specific term. So you don't have to worry too much about that.
I have another question. You're in Vancouver. Are these provincial? Are there provincial nuances around mortgages?
Somewhat. It's largely a national. The differences in the nuances tend to reside more around the costs and provincial government fees. Things like land transfer taxes vary. For example, Alberta doesn't have one, whereas BC and Ontario do. Mortgage qualification wise, there are different disclosure forms that need to be signed. Depending on the governing body that's managing that particular. So if I do a mortgage in Ontario, for example, I need a licensed mortgage broker and compliance form signed to meet their board's requirements.
It's administrative in nature.
Yeah.
Okay.
Yeah.
Aside from
but the qualification rules outside of Quebec, which kind of marches to their own drum, mortgage qualification rules are a federal standard.
And I think banks are particularly good at sourcing new clients, but I find they're not very good at rewarding loyal clients. What percent of your client base just simply renew with their existing lender, or as opposed to look at alternatives?
Yeah, banks are interesting on that side. It's I hear a lot of clients complaining about not having heard from their financial institution for a period of about 4.5 years, and then once that renewal comes up, look out, they're calling you like a desperate ex-boyfriend kind of thing. So it's an interesting time for sure. I would say about half of borrowers renew with their existing institution. It is a bit of a game on that side from my standpoint, and this is a source of frustration, I think, just for the lending industry in general. Like you said, banks are very good at sourcing new clients, but not as great at looking after existing clients. And my sort of running joke with borrowers is it's just like your bank's just not that into you, right? It's like being in a relationship with somebody that doesn't care about you nearly as much as you care about them. And I find borrowers have a lot of loyalty to their financial institutions, but not necessarily trust, because whatever is said to them gets vetted through alternative sources, and it becomes a bit of a game on that side of things. But there is this natural tendency to want to go with what you know, and it's like a little bit of Stockholm syndrome. You look at bank profits and how much they're making off of us, yet we have this desire to go back to them and make sure, hey, I've heard this offer somewhere else. Can you match this? And they'll happily do it for you. Whereas they're not the ones that are necessarily providing you that, putting their best foot forward to start with and looking out for your best interest. But they'll happily match and take that business.
Well, we see that a lot in our work as well. We get a chance to help Canadians take a second look at their investment portfolio, and invariably we find that they're getting spotty service. They've been promised a financial plan, but they never end up getting anything, and they're being charged an awful lot of money. And so I often say that inertia has its own sense of momentum, and we really do need to, as a community, recognize that there are alternatives to the traditional financial institutions. And I think what you and your colleagues in the mortgage broking industry are doing is hugely important. And I just encourage everybody to seriously consider reaching out and engaging a mortgage brokering professional when it comes time to either get a first-time mortgage or at renewal. Well, Ray, as we wrap up this coffee break, do you have any final thoughts on the experiences that you had, or advice to viewers?
I think just getting good advice, like you said, is a key piece of this, and recognizing where that advice comes from. I as you do, I hear a lot on my side from borrowers who have frustrations with the advice that's being given, or the fact that they're continually dealing with different people at different levels of their financial institution. There's just a lack of consistency there. And I think everyone could benefit from a second opinion. Doesn't mean you have to make a change. Doesn't mean you have to do anything. But at least knowing what that looks like and understanding what good advice sounds like is an important step that I think we can all make. And it does help. I mean, the reality is it does help to keep the banks a little bit more honest. And my favorite line is people tell me, my bank's been good to me. And my first response is, well, you must have them in your stock portfolio because they're sure not good to you anywhere else. So I'm not really sure how that correlates, but it is something that I think, they need to do a little bit better at, and something we can help with.
Yeah, I second that motion. Ray, thanks for sharing your insights and your knowledge on this incredibly important topic. And if people are interested in knowing more about your mortgage advice and your brokerage practice, and perhaps signing up for maybe a newsletter or following you on Instagram or LinkedIn, what's the best way to get in touch with you?
Our newsletter is something that has been probably our most popular thing. I like you guys. I really enjoy the way you communicate your messages. It's not like a bank, and nor are we. So on our website, nestmortgage.co, you can find me there and sign up for my newsletter. Beyond that, I am on Instagram at Ray at Nest Mortgage, and I'd be happy to connect with anybody and chat about any particular mortgage questions or advice that's needed.
Great. Well, thanks for that offer. And we'll be sure to include links to your website and Instagram profile in the video notes below, so you can sign up for Ray's newsletter. Well, thank you all for watching today, and be sure to leave any comments or questions you might have on the coffee break. We'll do our best to answer them. So, Ray, we may be coming back to you with some specific questions and follow up. And again, I invite everybody to subscribe to the Steadyhand YouTube channel and ask to be notified, so that you'll be notified when we load up new content. And one of the videos that you may be interested in looking at as well is about the process of assembling funds for a down payment. So whether you're a young home buyer or a parent looking for ways to help your children get into the housing market, this is a must-watch video for you, and we'll be sure to link to that video in the notes below as well. Thanks again for watching, and bye for now.